You've got $500,000 in your RRSP and $200,000 in your TFSA, and you're about to lose over $100,000 to unnecessary taxes because of one simple decision you make every year. Not a bad investment, not market timing, just which account you touch first. Most Canadians with both an RRSP and a TFSA instinctively reach for the TFSA first when they retire, and it makes complete sense on the surface. The money comes out tax-free. It doesn't show up on your tax return. It feels like spending your own money without owing anyone anything. That feeling isn't wrong, but acting on it without a plan is what quietly costs people six figures over a 20 to 25-year retirement. I've watched this happen more times than I'd like to count. Retirees who did everything right, saved steadily, stayed invested, didn't panic during downturns, and then gave back a significant chunk of it in the final act, simply because of withdrawal order. If you're a Canadian between 55 and 65 with both an RRSP and a TFSA, stay with me for the next 9 minutes, because I'm going to show you the actual numbers behind two identical retirees, same savings, same pension, same CPP, who end up $100,000 apart by age 80. The only difference is which account they drew from first. If that's the kind of concrete, no-fluff retirement planning you're looking for, hit subscribe now. This channel is built for people exactly like you. Let's run the numbers on two retirees. Call them Retiree A and Retiree B. Both are 60 years old. Both have a $500,000 RRSP, a $200,000 TFSA, a company pension of $30,000 a year, and they both plan to take $40,000 in spending money each year from their registered accounts. Retiree A goes TFSA first. Every year, $40,000 comes out of the TFSA. The RRSP sits untouched, growing at roughly 5% a year. Retiree B does it differently. She takes that $40,000 from the RRSP each year instead, pays a moderate amount of tax on it, and leaves the TFSA completely alone. Fast forward to age 72. That's when CRA requires both of them to convert their RRSP to a RRIF and start taking mandatory withdrawals. The minimum withdrawal factor at age 72 is 5.4% of the account balance. Retiree A never touched the RRSP. 12 years of 5% growth on $500,000 leaves her with roughly $900,000 in her RRIF. Her mandatory withdrawal is around $48,600. Add her $30,000 pension, $15,000 in CPP, and $8,000 in OAS. That's $101,600 in total taxable income. The 2026 OAS clawback threshold is $95,323. She's $6,300 over. CRA claws back 15 cents for every dollar above that line. She loses about $945 that year alone, and the number climbs as the RRIF grows. Retiree B drew down her RRSP for 12 years. Her RRIF balance at 72 is around $450,000. Her mandatory withdrawal is roughly $24,300. Add the same pension, CPP, and OAS. That's $77,300. She stays comfortably below the clawback threshold. She keeps every dollar of OAS she earned. Over a 20-year retirement, that OAS clawback alone costs Retiree A around $60,000. And that's before you account for the higher marginal tax brackets she's pushed into on top of it. So why does Retiree A still make this choice? Because it feels right in the moment. When you first retire, say you're 60, 61, 62, your taxable income is often at its lowest point in decades. CPP hasn't started, or you've deferred it. OAS isn't in the picture yet. Your pension might be moderate. This is the lowest tax window of your retirement. And if you spend that window pulling from the TFSA, you're burning the tax-free buffer when you need it at least. Meanwhile, the RRSP keeps growing, tax-sheltered. Every year you leave it alone, the future RRIF minimum climbs. And by the time forced withdrawals hit at 72, You may have more taxable income than you ever had while you were working. If you're like most of my viewers, a Canadian 55 or older, with a mix of registered accounts, a company pension, and CPP coming down the road, this is exactly the trap that catches people. Not because they weren't paying attention, because the TFSA genuinely does feel tax-free. And it is. The cost is invisible until it isn't. So you now see the tax cost of getting withdrawal order wrong. But there's another hidden trap that can cost you real money the moment you try to use your TFSA as a flexible lever, and most advisors never bring it up. I want to show you that penalty next, because avoiding it is simpler than you'd think. Here's something that most people don't know about their TFSA, and something a lot of advisors gloss over entirely. When you withdraw money from your TFSA, that contribution room comes back. But it comes back on January 1 of the following year, not the moment the money leaves the account. If you take out $10,000 in June and redeposit $10,000 in August, you've just over-contributed. CRA charges a penalty of 1% per month on the excess. On a $10,000 over-contribution, that's $100 for every month the excess sits there. I used to tell clients to use the TFSA as a spending account, pull out what you need for a vacation or a car repair, put it back when the cash flow recovered. It took one client receiving a CRA penalty letter for me to realize how dangerous that advice was in practice. The rule sounds simple until you're in the middle of real life and you've lost track of the date. So here's the system I now recommend. It has two parts, and it takes about 5 minutes a year to manage. The first part is the withdrawal calendar. Anytime you take money out of your TFSA, you write the date and the amount on a piece of paper, or a note on your phone, or a sticky on the fridge, whatever you'll actually look at. You do not redeposit that money until January 2nd of the following year. Full stop. That's the only rule for the first part. Let's say Mark and Lisa are both 62. They have $150,000 in their TFSA. In May, they need $20,000 to cover a major home repair. They withdraw it. In November, their investments pay out a dividend, and they want to put the $20,000 back. If they do that before December 31st, they've over-contributed. 2 months of 1% penalty on $20,000 is $400, not catastrophic, but completely avoidable. The calendar system prevents it. The withdrawal is noted. January 2nd, the money goes back in, no penalty, no letter from CRA. The second part is the one in, one out rule. If you know you're going to need money from the TFSA, plan the withdrawal for early in the calendar year rather than late. That way, if you want to redeposit anything before year-end, you still have options. Pulling $20,000 in January gives you until December 31st to decide whether you want to return any of it. Pulling $20,000 in October gives you almost no runway. The TFSA is a powerful tool, but only when you use it with this kind of awareness. It was designed to be flexible, and it is. You just need a system that keeps you on the right side of the calendar. Now that you know how to use the TFSA safely as a lever, the next question is, when should you be using it? Because there's a broader context to this that most people haven't seen, and it helps explain why this trap keeps catching otherwise careful retirees. The OAS clawback threshold has been climbing for years. In 2015, it was around $72,000. By 2026, it sits at $95,323. That's a meaningful increase, about 32% over 11 years. But here's the thing. The income of a retiree with a full company pension, CPP, OAS, and a moderate RRIF can easily push past $95,000, especially if that RRSP was left alone through the early retirement years. The threshold moves, but for many Canadians, the income stacks faster. In 2022, roughly 5% of OAS recipients were subject to clawback. That number is expected to grow as the baby boom generation moves deeper into their 70s with larger registered account balances than any previous cohort. These are people who had access to group RRSPs, defined contribution plans, and decades of contribution room. Their balances, when converted to mandatory RRIF withdrawals, are going to stack on top of CPP and OAS in a way that pushes a growing number of them over the threshold. This isn't a problem reserved for the wealthy. It's a math problem. If you have a pension of $30,000, CPP of $15,000, OAS of $8,000, and a RRIF producing $48,000 in mandatory withdrawals, that's $101,000. You're over the line. None of that is extreme. That's a pretty ordinary retirement picture for someone who worked a professional job and saved consistently. But the income stacking is real, and the clawback is real, and the only lever you have to reduce the RRIF portion is the withdrawal order you chose in your 60s. That doesn't mean you're doomed if you haven't started. It means the decision you make today, or in the next few years, about which account to draw from first will determine whether you join that growing group or stay safely below the line. And there's another force working against good planning here. It's not math, it's psychology. I want to address something directly because I hear it a lot. If you're sitting there thinking, Brian, I saved my whole life. I'm 63. My knees hurt and I want to travel while I still can. I don't want to defer everything to age 80 so I can leave a bigger estate for my kids. That is not foolish. That's human. And it's a completely reasonable thing to want. I've sat with clients in their late 60s who said that exact thing. I saved all my life, and now I'm too tired to travel. That stays with me. That's why I'm not here to tell you to lock up every dollar and optimize your estate on paper while your life passes you by. But there's a difference between spending and spending without a structure. The problem isn't wanting to enjoy your retirement. The problem is the binary thinking. Either I spend freely from the TFSA right now, or I defer everything and live like a monk. There's a middle path, and it's a lot simpler than people expect. Here's what it looks like in practice. You set a fixed annual amount to spend from your TFSA specifically on life. Travel, a family trip, experiences that matter to you. Let's say $10,000 a year. That money is yours to spend freely, no second guessing. The rest of your spending comes from strategic RRSP drawdowns, managed within the tax ceiling we talked about. The TFSA balance above that $10,000 annual carve-out stays intact, ready for large, unexpected expenses, a medical bill, a home repair, a car. This approach gives you permission to enjoy your retirement without quietly dismantling the financial structure that protects the back half of it. You get the trip. You also keep the tax position. The emotional comfort of the TFSA is real. The flexibility is real. But so is the future cost of using it as your primary income source when a better option is sitting right next to it in the RRSP. So what does the actual implementation look like? That's next. The 4 steps you follow to put this into a working plan. Let's put the 2 paths side by side clearly because the contrast is important. Path 1, you retire at 60 and draw from your TFSA first. In those early years, your taxes are low, you feel good, the money comes out clean, the RRSP grows untouched. By 72, you've got a large RRIF balance with mandatory withdrawals that stack on top of your pension, CPP and OAS. You're in a higher tax bracket than you were at 55. Your OAS is getting clawed back. When you eventually pass away, whatever is left in the RRSP or RRIF is treated as income in your final tax return. 40 to 50 cents on the dollar goes to CRA. Path 2, you retire at 60 and begin drawing down your RRSP strategically. In a province like Ontario, the first federal plus provincial bracket tops out near $55,000 of taxable income after basic personal amounts. You aim to withdraw up to that ceiling each year from the RRSP, pay a moderate rate of tax, and move some of the after-tax proceeds into your TFSA to top it up. CPP and OAS are deferred to 70 if your cash flow allows it. Deferring CPP to 70 gives you 42% more than taking it at 65. The TFSA grows as the RRSP shrinks. By 72, your RRIF minimum is manageable. Your total taxable income stays below the clawback threshold. You keep your OAS. Here's one more number to make this concrete. If you withdraw $40,000 from your RRSP each year between age 60 and 64, that's $200,000 in RRSP drawdown. Depending on how much tax you pay, you might shift $150,000 to $160,000 of that into your TFSA. That reduces your future RRIF balance by roughly $200,000, which cuts the annual mandatory withdrawal at age 72 by about $10,800 a year. Permanently. That's real money, and it compounds forward through every year of your retirement. The next section shows you exactly how to build this plan. Here's how to pull this together into something you can actually use. Step 1. Map your income ceiling. The OAS clawback threshold for 2026 is $95,323. That's your upper guardrail. Sit down and add up what your fixed income will look like at 72. Your pension, your estimated CPP, your OAS. Whatever's left between that total and $95,323 is the room you have for RRIF withdrawals before clawback kicks in. Work backwards from that number to figure out how much RRSP drawdown you need to do in your 60s to keep your RRIF balance in check. Step 2. Run the mini meltdown. Between the year you retire and your 71st birthday, make a plan to withdraw a set amount from your RRSP each year, enough to reach the top of your effective tax bracket without going over. Take the after-tax money and contribute it to your TFSA. Do this consistently. By the time RRIF minimums begin, your registered balance is smaller, your TFSA is larger, and your tax position in your 70s looks very different. Step 3. Build your TFSA withdrawal calendar. Your TFSA is your lever. Use it for large, irregular expenses only. A new car, a roof, a medical procedure, a major trip. Every time you make a withdrawal, note the date and the amount. Do not redeposit that money until January of the following year. That's the whole calendar system. It doesn't need to be complicated. A sticky note on your fridge with a date and a dollar figure is enough. You might be wondering, what if I need emergency money and my TFSA is my only liquid account? Do I really have to wait a full year to refill it? That's a fair concern. The calendar system includes a simple buffer. If you genuinely cannot wait, you accept that the redeposit will have to happen in January. In a real emergency, a one-time $100 to $200 penalty is not the end of the world. The system isn't about perfection. It's about not making the redeposit mistake accidentally. Meet Susan, 64. She has $80,000 in her TFSA and she's just been hit with a $50,000 unexpected bill, a water main replacement on her property. She withdraws the full amount. In October, she sells some non-registered holdings and wants to put the $50,000 back. She waits. January 2nd, the money goes back in. No penalty, no CRA letter. Just a calendar reminder that kept $500 in her pocket. Step 4. If you have non-registered investments, use those for routine spending before touching registered accounts in either direction. Non-registered withdrawals give you control over which gains you realize and when. They don't force up your taxable income in the same blunt way that a RRIF withdrawal does. I'm not pretending this works identically for everyone. If you have a pension that already puts you close to the clawback ceiling, your room for RRSP drawdown is narrower. That's exactly why you review this math annually, not once and never again. So let's bring this back to where we started. Your TFSA isn't your retirement checking account. It's your backup, your flexible reserve for lumpy, unpredictable expenses, and your tax shelter for the back half of retirement when you need the income flexibility most. The plan is straightforward. Draw down your RRSP strategically in your 60s, before forced withdrawals begin. Keep your taxable income below the OAS clawback ceiling. Use the TFSA for large irregular spending, manage withdrawals with a simple calendar, and redeposit only in January of the following year. Defer CPP and OAS if your cash flow allows it. Review the numbers annually because your situation will shift. None of this requires a financial designation. It requires awareness and a consistent habit. That's it. If you're a Canadian trying to retire on your own terms, without giving CRA more than your fair share, hit subscribe. I put out new, concrete retirement planning content every week for Canadians who are working through exactly these decisions. Thanks for watching. You've already done the hard part. You paid attention. Now go do something with it.